Wednesday, June 5th, 2019, Maneco 64, home of alternative economics and contrarian views. This morning I want to talk about how, in my opinion, this central banking experiment with unconventional monetary policy, extremely low interest rates at zero or even negative, is going to end in tears. Of course, I've been warning about this for the last 3.5, 4 years through my videos here on YouTube. I was warning people already, colleagues, friends, family back in 08, 09, that it would end in tears, that it would not work. And why do I have that opinion? Well, through reading about history, and today especially I want to look at a very interesting book that's very short. It's less than 70 pages, so it can be read really quickly, and it's really interesting, and it's free. You can get a free PDF online, or you can buy it. So the book is Fiat Money Inflation in France: How It Came, What It Brought, and How It Ended, by Andrew Dixon White. It was written in around early 1900s, so here it is. Highly recommend it. Before I go into the book today, I will look at the major headline, in my opinion, in terms of the markets and what's happening lately. And then I'll look at the markets as well and finish off with the book. So, of course, many of you already probably know that the Fed chairman actually said that the Fed will probably, could start cutting rates again, and that the Fed could resume its unconventional policy. So here it is. Jay Powell says Fed is ready to act if trade wars hit economy. So again, there he's blaming the trade wars. I would blame more the Federal Reserve for this. I would blame, the long period of time that they left rates near zero, the almost $4 trillion that they created out of thin air to buy securities and park it in their balance sheets. That's what I would blame. And then I would blame them as well for not knowing where they were. Even Jay Powell, months ago in one of his press conferences, used the analogy that the Fed was in the dark, that they were like walking in a dark room. So that's what the Fed realized, and Jay Powell realized late last year, that the Fed rate hikes, which were supposed to be going on this year, and the economy is doing great. A record low unemployment rate, GDP above 3%. So now Jay Powell is talking about cutting rates, and he's blaming trade wars. Now, it's got nothing to do with trade wars. It's got to do with the fact that the Federal Reserve cannot normalize its policy, and whenever it starts raising rates just slightly, it brings the whole system down. Well, the FT says Jay Powell, chairman of the Federal Reserve, signaled the central bank stood ready to cut interest rates. So less than about 6 months ago, with the economy doing just the same as now, they're going to hike 2 or 3 times this year. Now they're talking about cutting. The Fed has lost credibility with me a long time ago, but now even more. And I'm surprised the markets and investors are still finding the Fed, credible. And I think that credibility is running, very thin, in my opinion. But let's see what it says here. Saying it would act as appropriate to sustain the expansion. I would say to sustain the stock market and the credit bubble, and to help his buddies on Wall Street. That's what I would say. Amid the economic impact of escalating trade wars. I have said in the past they're going to use that as a scapegoat. So he said, we do not know how or when these issues will be resolved, in remarks that helped stoke a powerful rally on Wall Street. We are close. And he also said, we are closely monitoring the implications of these developments for the U.S. economic outlook. Also on Monday, James Bullard, president of the Federal Reserve Bank of St. Louis. He also said that a rate cut might be warranted soon. That's with the unemployment rate less than 4%, GDP supposedly 3%, everything going great. Why an interest rate cut? Well, because the stock market is under pressure. In the past, we've had this bullard put come in many times when the market was like testing key technical supports. So this is about the stock market. I think he was speaking at Federal Reserve Bank of Chicago or something, and behind him was a big thing saying the Fed listens. He said that the unconventional policy might become conventional now, so he would be willing again to do QE. That's what it signaled. And I wouldn't put it past them of testing the zero bounds. What does that mean? Well, they would probably start even thinking about having negative Fed funds rate or negative interest rates. And that's why the stock market rallied so much yesterday. We got the Dow. Dow was up 512 points, just over 2%. S&P was up 58, just over 2% as well. And the NASDAQ 100 was up 194, 2.65%. So do I think this is it? The stock markets now are out of the danger zone? No, I don't think the Fed is going to be able to fight the turn in the credit cycle. And of course, this is much more than just the trade wars. They're using this as an excuse because they don't want to look at themselves in the mirror and see that it's their irresponsible policy of easy money for over 10 years that's done this. And so where are we this morning? Quickly go through the markets before I go through this book. Well, gold is doing quite well right now, actually. We're up 8 at 1333.28. So that's a new high, which is encouraging. The high overnight has been 1334.30 and the low 1324. Silver is only up 3 cents, up 0.2% at 1484. We'll have to see if silver catches up later on today. That's what it's been doing of late. The Dow is up 36, S&P is up 5, NASDAQ 100 future up 20. So by the way, it's just before 8 a.m. London. The currencies, we've got the pound just around 127, so that's a little just unchanged. The currencies were higher yesterday against the dollar. The euro did quite well. They were up about 0.25%. Euro right now is unchanged, 112.60. Dollar is down about 4 pips against the yen, 108.10. Chinese yuan is fairly steady as well at 692. Crude oil down 1%, WTI at 53.01. Brent crude 61.30, down 0.2%. The stock market, the bond market, yields did rally back up a little bit yesterday after Powell's comments, which seem more longer term yields, which seems weird that he says they're ready to cut rates and yields go up. But that's more the longer term. The 10-year went back up to above 210. It had dropped below 210. This morning we are at 210, down about 2 basis points. The bond market's still not buying the Fed's, stance, I would say. I think still saying the economy is going to go, get into trouble. It will be interesting to see if the Fed will be able to extricate the economy from trouble. Don't forget, back in 08-09, there was fiscal room, there was interest rate room. They could cut rates. Government could raise the spending. Am I saying these are all right? No, I'm just stating what happened. Right now, we already have a budget deficit of almost 6%. So how is the government going to spend even more in such a scenario? I think, nothing good will come out of this. And that's why I come onto this book now, Fiat Money, Inflation in France, by Andrew Dixon White. This is one of the classic books, I think, that I've read about monetary history, economics, and I highly recommend it. I read it many years ago, probably in 2002 and 3. So that's why I've always been quite skeptical about this unconventional monetary policy that they've had. I remember back in '02 listening to the Bernanke speech about the printing press, that they can always print money. And I could tell back then that the Fed was going to go, they're going to keep going. And this doesn't surprise me. But this is about the period in France just after the revolution in 1789, up until the mid 1790s, where France was in a very bad fiscal situation. It was bankrupt almost. The economy was in a depression. There was, of course, political chaos. They just executed or guillotined Louis the XVI and Marie Antoinette, French Revolution, they decided to do this experiment with paper money, and they started issuing assignats. And there was a lot of debate in the French National Assembly whether they should do it, because it was something that was very unconventional and not normal for the time. And they decided, though, to go through with the experiment. It was like the QE of the late 18th century. And reading through this, all the symptoms that we had in France back then, that rising prices, the reign of terror, government trying to control prices, it's all happening now too. And the other thing that's the most important that I got from this book is that once you go down this road of issuing irredeemable currency or paper money or fiat money, whatever you want to call it, it does improve the economy, like temporarily and in the short term. But then the sugar rush, the effect of it goes down. Unless you start issuing more. But the more you issue, it improves temporarily, but then things get even worse. And then you have to keep issuing more. And then at the end, everything implodes. You have to go back to gold. And that's what happened eventually in France. So I highly recommend the book. It will show you exactly what we're going through and what I think will happen, in my opinion. And what happened at the end? Well, I got this from this website called siteco.fr, 1,000 Years History Economics. It says 1797, so this was just after this period where they finally decided to abandon this experiment. And I think we are in an even bigger experiment, because this just happened in France. It says here, 2/3 bankruptcy in France, the state being heavily burdened by debt inherited from the royal administration and the revolution. Dominique Ramel, Minister of Finance under the Directory, decided to close the government securities market and passed a law canceling de facto 2/3 of the public debt. Through this 2/3 bankruptcy, his intention was to erase the consequences of past mistakes to provide the state with the means to its future. So you see this photo here. This is what it says. The printing presses, punches, dies, and assignats used for making money are burned on the Place Vendôme, 1796. So it had such a horrible consequence that people were sick and tired of it. And they burned the printing press, the punches, the dies, and the paper money itself. Am I saying that's what we're going to see? Of course not, because it's different today. But I think something similar will happen to this central banking experiment we're under. And it's not Jay Powell's fault. He's just carrying on the experiment. I think it started with Alan Greenspan actually in 1987 when he took over. So there you have it. That's why, in my opinion, this will end in tears. If you enjoyed the video, make sure you hit the like button, subscribe to the channel if you haven't yet. You can also follow me on Twitter, Steemit, and on DTube. I wish you all a great day. Take care. Bye.